Hello, sir.
Tamara.
Hello.
Hey, how you doing?
I'm good. How are you?
Wonderful, wonderful. We got a lovely presentation here today.
Okay, great.
Yeah.
I guess I don't know how to. Do you see my screen now?
Yes, I see.
Okay. So I
Yes.
don't know how to share with you though.
So make me a co-host.
Okay, I don't know if I have that package.
So do you have
So I have Zoom, but I don't know if we're paying for the co-host thing. So
everything comes with the pro plan already. So click the participants, and then at the upper right you're gonna see the participants. It's three of us.
yep,
Highlight my name, and you're gonna see more. And
yep.
it's going to give you the option to make me a co-host.
Ah, okay.
Yeah, I went through when I first got Zoom. I went through their like training. They got like a training program that you sign
Okay.
up. So
Yeah, I went through their YouTube video kind of situation, but so now you are actually co-hosted.
yeah. So now I can be able to share my screen and stuff like that. That's all.
Oh, wonderful. Wonderful, wonderful. That's good to know. See, I learn something every day.
So we're starting at 2, or we're going to give people time to get in. How do you want to do that?
Well, I'll start at 2 and just kind of introduction of who we are. So then by that time, people should be in, and then you'll get started. So I have a few slides just talking about upcoming workshops and stuff.
Okay.
So at 2 o'clock, in the next 5 minutes, I'll get started with that. And then by that time, people will probably be coming in. And then by that time, you can get started. So,
no problem.
Yeah. So I think we're good. I had now it's about 20 people that actually registered.
Okay.
So we'll see. We will see.
For those that don't get in, they're going to be missing out.
Hey, I mean, this is what we get calls about. And then, people are like, can you help me? And it's like, you need to talk to experts, and you need to be doing this now and not waiting. This is probably something we could have did years ago. People need to work on this like now. So yeah, I'm gonna think everything is good. Sound is good. So I see people are hopping on. So, and I had to get my green screen, so I actually created one, so I can have backgrounds.
Okay. Latanya and Tanya. That's so convenient. That's convenient. Man, you're like, which one are you talking about? Which one are you talking to?
Yeah. Latanya works with us. She works with the GECDC.
Okay.
Yeah.
Hi, I'm Tanya. I'm actually out of state. I see you all from Chicago.
Yes.
Okay, I'm in New York.
You're in New York?
Yes.
Okay. How's the weather?
It's kind of cool and rainy up here.
Okay.
Yeah, it's not. It's all right.
Okay. Yeah, it looks like we got a nice bright day today. Night breeze, but it looks to be nice today.
Oh, okay, that's great.
Yeah. So great. Thanks for joining us.
Thank you.
I'm gonna go ahead and we'll get started. Just with a few introductions, kind of introduce who we are. We're the Greater Englewood Community Development Corporation. So we offer services in 3 different areas or pillars, and that includes small business, workforce development, as well as real estate development. And so this series that we're going to be doing, we normally do the workshops like on site, at our office, but since everybody's on shutdown or whatever they want to call it, we actually went virtual like everybody else is doing, and decided to offer a financial series of different packages and things that can help our small businesses. And so it's a great opportunity to not only help people in Chicago, but also just all across the globe. And so it's great to have others online. I think this topic that we're going to talk about today is essential. Just as a small business advisor for the Illinois Small Business Development Centers, we get calls all the time. And many times with some of these kind of grant programs and lending programs that are out and are made available, the hang up is when there are challenges with their financials and things like that. And especially going after a loan, sometimes credit is a challenge as well. And so really kind of understanding how we can do this in a way that prepares us so that we don't get caught up in challenges later on in life. So really glad in the opportunity to have Mr. Jackson on the line with us today with Credit Honor, and he is going to blow your mind with information. So if you know somebody that needs to be on this webinar today, you need to send them an email right quick and say, hey, you need to hop on this, because I've been at several of his presentations and I always learn something new. So really excited. I want to share with you just on my screen, and he'll be sharing with you, but I wanted to share with you, before I do that, though, go back to let you know that this is a two-part. So today is part one, and then we'll be right back with part two on May 8th. So make sure you get registered for that. Just some of the upcoming workshops that we're going to be doing at the Greater Englewood CDC. We have some pre-recorded workshops already that are out there. Proposal Writing 101, Starting a Business in Illinois, and then the Department of Commerce and Economic Opportunity registration. So you'll see that on the screen, these things that are made available, but also just an opportunity to be on some live streamings that we'll be doing. So, of course, today with personal credit, but then on the 12th, we'll be doing the Intro to Financial Literacy, 15th, Starting a Nonprofit 101. So we get a lot of people that want to start a nonprofit, so we'll be going through that process. We have a program called Growth Wheel, and so we will be taking people through crises management and talking about how do you manage crises. And then May 26th, we're going to be doing a social media workshop. So just really excited about some of the things that we'll have available. Want to direct you to our website, which is www.gecdc.org. So if you want more information, you can always email us as well. But you can go to our website and click on events, and you'll see everything that we're doing. And we just thank you for the opportunity for those that are jumping on. If you have any questions or anything that you need assistance with, definitely reach out to us. So I did my spiel. Mr. Jackson, it's all yours. I'm going on mute now. So go ahead.
Definitely thank you so much for today, Ms. Hughes, and I promise to definitely deliver and make sure that everyone get this information. And it's a lot of information. I will tell you, it's a lot of information. So please, if you all can take notes during this process. Of course, it's recorded and things of that nature, but sometimes you remember more by actually writing out certain things. So if something stands out to you, definitely write it down. I do have a survey at the end. Please take the survey. Let me know how I can improve once we're done with the presentation overall, and then we will begin from there, and then we'll provide feedback in other methods to it. So let me minimize this video over here. All right, so my name is Anterio Jackson. I am from Chicago, Illinois. I went to Finger High School, graduated from U of I, worked at the Chicago Urban League for over 6 years, was in the education department for a number of years, and I created a program called the Project Ready College Program. I sent over now today about 557 kids to college with scholarship money averaging around $56,000 in scholarships per student. I currently operate and own a company called Credit Honor, which is a credit builder consulting and financial services company dedicated to helping individuals, families, and businesses protect their health, wealth, and legacy. The reason why I started this company is because of several reasons. I was definitely taken advantage of with the information, not knowing about credit, and taking advantage of the information, trying to get people to help me build my credit, and they took advantage of it. I put things and items in my name, got Land Rovers and cars in my name for family and friends, only for them to not hold up their end of the obligation and support in making the payments to those different installment accounts that I have. Another reason is that credit education and finances are not taught on purpose, and many people have been educated to know only a fraction of the whole story. The third and final reason is that I'm very passionate about education, presenting quality content, and really delivering on my promise. So I make sure clients and partners are well informed about this information, and a relationship that's built upon that information means more to me than just a one-time monetary transaction that most companies similar to mine do. Right, so I already went into detail as to what my business does, but from a standpoint of what it is, I pretty much specialize in helping people reach their goals through financial superiority, goal setting, and wealth building. And my mission is to engage, educate, and empower my clients. So I want to be the most reliable and impactful brand as it relates to financial services and the like. So we're going to get started into the presentation. I'm going to tell you a brief history of credit. Credit is not a new concept. We've been using it since ancient times. We've bartered with currency and services in order to maximize our spending processes and often collecting what we now call interest on payments that were once late or past due. Credit cards themselves, however, didn't surface until the early 1950s. And American Express and what is called and a Diners Club were the forerunners in plastic money, and they issued their first credit cards to fewer than 200 Americans for use in restaurants and entertainment venues in New York City. So this was pretty much an exclusive club of setup of certain businesses who had access to the first credit card. So more of its kind were issued in New England to the late 60s. But none of these credit cards could be paid off over long periods of time. Their balances were due immediately. So essentially, these types of cards were the charge accounts. Originally, American Express you couldn't leave a balance. So if you spent $3,000 within 30 days, you have to pay it back the full amount. You couldn't leave a balance, or they'll hit you with a nice fee, or they'll cancel the card and shows up as a collection on your report. Bank of America issued the Bank AmeriCard in California in 1959, and this was the start, the first card to be accepted almost universally. And then we have here just an illustration of what the credit card looks like. In the 1970s, the first magnetic strip was developed, and this was what launched the use of credit cards as we know them today. Although the magnetic strip was used in England in the early 1960s, it was not standardized until the 70s in the United States. So here's what the back of your card means as it relates to that. So we got the magnetic strip, the hologram, which is for protection reasons, for people not being able to duplicate such cards. You got the bank contact information, the signature area that must be signed when you're making transactions or before you make transactions, the security code to be able to access that information for payment, and of course the network's logo. So that's what that all means. So as it relates to the history of credit, the Bank AmeriCard eventually became Visa, what we know today. MasterCharge, formed in the late 60s, eventually became MasterCard. They were the two most popular credit card issuers as they remain today. They revolutionized the magnetic strip on credit cards and began to form credit card offers that allowed debts to be paid off incrementally. So that's where they created the revolving balance that we all have for most credit cards, rather than a charge account where you can only pay the full balance every month and not leave a balance. So they revolutionized that. As the bank card industry became more widely spread, financial institutions that were interested in issuing credit cards began to align themselves with either the Visa Association or the MasterCard Association. If you guys have questions, let's definitely save it to the end. I have a lot of information to process, so please let me get through this. And whatever questions you have, just kind of write them down to the side or put it in the chat, and I'll answer them later, I promise. Using this method, even small banks were able to make credit cards available by sharing program costs and offering universal solutions to consumers. So in the late 80s, this was made even easier when bylaws were generated to allow any single financial institution to offer both the Visa and MasterCard bank cards. So this is pretty much like a white label program of sorts, where you can put their logo and the banks. Like, so we got a Chase Bank card, we got Bank of America card, we got Fifth Third Bank types of Visa cards or MasterCard. So this allowed them to pretty much put their stamp and logo on it and things of that nature. So in the late 80s, processing companies began to emerge, which allowed both Visa and MasterCard to streamline their paper flow processes and to reduce the possibilities of credit card fraud. This offered mediation to credit card association members so that disputes could be be resolved quickly and easily with less cost to financial institutions, because it was costing a lot to do that. So here's how the process worked. Hopefully you guys can see it. If it's clear, I have to stretch this out for you to be able to see it. So number one, the customer pays. That's what a credit card in the upper left, if you can see my mouse. This is where we start. The customer pays with the credit card. The merchant captures the credit card information. The merchant reaches out to the credit card issuing bank and then is credited with the actual submission. The back-end processor pays the acquirer and debits the card issuer account transaction to the issuer. They acquire the funds in the merchant account, and then it goes to the issuer's post-transaction from the customer's account to the bank, and the customer sees a statement and pays the issuing bank. So that's how the credit card payment process works as it relates to when you all make a transaction, whether it be online or usually in a brick and mortar store. So until 1987, American Express had remained on the back burner, only offering credit cards that had to be paid immediately. And their target consumers were high rollers in business industries who used the cards for entertainment purposes and could then pay off the balances. So people with money could pay out the balances, right? So, but keeping in with the new trends exploding across the United States, they altered their business model a little bit to accommodate the average consumer, thus becoming another forerunner in the credit industry. So what this is saying is that American Express now, they went from having a charge account where you can only pay the full balance, whatever you spend, you pay the full balance every 30 days. Now they say, hey, let's follow this trend. We'll add a new credit card in our repertoire of credit cards. Now we can hold a revolving balance that you can continue every month. So they added and went to that. And here's a link at the bottom. If you all wanted to see this at the end, it'll show you how to get the American Express Black Card. I got the instructions on how to get it. For those of you who are chasing status, I have the actual Centurion Black Card and how to get it. So a Discover card appeared in the early 90s as an alternative for consumers, originally a division of Sears Corporation, now owned by Morgan Stanley. Discover card sought to change the credit card industry by offering alternatives to the Visa and MasterCard traditions. Discover is now one of the most largely accepted forms of payment worldwide and rivals only American Express internationally, right? So credit cards have changed astronomically over the last 40 or so years. You will definitely undoubtedly continue to evolve as further technology is developed. So in recent years, measures against fraud and identity have been implemented, and credit card companies are now offering more and more benefits to consumers. The competition between Visa, MasterCard, American Express, and Discover has proven definitely a significant benefit to the public and will likely continue to grow as it relates to that. So the history of FICO. So FICO was founded in 1956 by engineer Bill Fair and mathematician Earl Isaac. And it was originally named Fair Isaac and Company, right? So initial goal was, according to its website, was to improve business decisions by using data intelligently. Fair Isaac developed and sold their first credit scoring system in 1958, all right? So in 1991, FICO scores were released to the 3 major credit bureaus, and by 1995, Fannie Mae and Freddie Mac were recommending the use of FICO scores for mortgage lending. This is where that all happened. So when people look at Vantage scores versus FICO, I'll show you in the later slides why they're so different. In 2009, the company officially changed its brand name and stock symbol to FICO, F-I-C-O. All right, so Vantage score, here's a brief history on the Vantage score. So Vantage scores were jointly introduced by the credit bureaus. So it's a joint venture created by the 3 bureaus, Equifax, Experian, and TransUnion, in March 2006. Most people don't know that. They weren't here that long, right? So like the FICO, Vantage score at its core is complicated formula that takes information about a consumer's payment behavior and crunches it into a single 3-digit number. Credit scores tell lenders how risky a borrower you are and are a key factor, sometimes the only factor, in their decisions on whether to lend and at what rate, right? So the higher the number, the better the deal is for consumers. So here's the punchline: Vantage versus FICO. So we always heard the debate, who's better, who gives the best? Well, I'm going to break it down for you. So FICO is more like Apple, proprietary, more secretive. Vantage is more like Android, used in many places, open source. That's no shade to all my Android users. I'm an Android user, but it's just to show you a comparison as it relates. It was a funny comparison. It wasn't really factual. So FICO has 5 main factors and Vantage score has 6 main factors. This is why the scores are so different. So the scoring model, FICO, and then on the right is Vantage. Payment history is 35% for FICO, and for payment history for Vantage is 40%. Credit utilization is 30. Credit utilization for Vantage is 20%. You have 15 over here. You have age and type of credit is 21%, a different algorithm. Types of credit accounts is 10%, whereas credit balances are 11%. Credit inquiries are 10%, whereas recent credit is 5%. Now you understand why the scores are so different, and I got more illustrations coming up. Available credit, additional 3%. Consumer score range is 300 to 850. Consumer score range is 300 to 850. Now I understand that Vantage score and FICO, they all have different types of scoring models. It's based on what the purpose is for. So for example, with FICO, a mortgage company may look at different criteria or similar criteria than a car dealership, right? They may have different criteria, and the scoring is different for both, right? So the importance of having a mortgage versus the importance of having a car, those are different paradigms, if you will, of what the consumer will most likely make payments on versus not, right? So the range previously used to be 501 to 990 for Vantage score, because people would think, oh man, I have such a high credit score advantage, and they're using Credit Karma. Understand that Credit Karma uses the Vantage 3.0 scoring model. So when you go to the dealership, and I put this on the Facebook post on my Facebook page. If you using Credit Karma and you're going to apply for a car, a credit card, a student loan, a personal loan, or a mortgage, the lenders are 99% of the time going to pull a FICO score. So Credit Karma is not a credit monitoring site. What they do is market to you their products and services offered by credit card companies and lending companies. So how they operate is they get your information, well, you give them your information, they scrape your data from 2 bureaus, not 3, Experian is excluded, so they give you Equifax and TransUnion. They get your data, and then they put your numbers in their algorithm, their scoring, and when things happen, they send you a notification. They recommend, hey, apply for this loan, apply for this credit card, and once you apply, they get a kickback, a commission on everything that you spend, everything that you apply for. So that's their position, and they have millions and millions of people thinking that's the true score when it is not, when most lenders use the FICO score. Vantage is only a consumer score. FICO is the one that everybody goes with as it pertains to the real truth and facts and numbers and information. FICO sued Vantage at one point, but soon found out that they lost the case because you can't own numbers. That's a fun fact. So here's another look at the FICO versus Vantage. Even the scoring ranges, I put letters in them for a report card, just to give you an illustration as to, what is A versus B and C and stuff like that. So if we look at let's look at the B and C categories. Even the ranges are slightly different as it relates to the scoring process. For those that want A plus work, it has to be at 800 and above as it pertains to FICO. Whereas a very good is different from a good from FICO to Vantage. So this is a difference along with that. Moving on. So FICO score rating, of course, at 800 plus, exceptional, well above average. You as consumers demonstrates to lenders you are an exceptional borrower. 740, very good. 670 is a good. 580 to 669 is a fair, and anything below 580 is considered poor. My ideal place for when people are looking to apply for things within FICO would be at least a 680 and above. That would be a really good placement. So 680 and above, or 720 or 740 and above. It just varies based on what you're applying for and what the lender is asking or the car company is asking as it relates to your credit score and your situation. So credit bureaus. So with the credit bureaus, most people are not familiar with the credit bureaus, but they are a company that collects and maintains individual credit information and sells it to lenders, creditors, and consumers in the form of what is called credit report. So whenever you provide information about yourself on a credit application with a creditor, that information usually will end up in a credit bureau's files. So credit data for millions of Americans is continually maintained and updated by credit bureaus. So creditors who use credit bureaus by providing and receiving credit information include finance companies, commercial banks, major department store department stores, savings and loans, credit card companies, and so on, and any other business that does not have the time or staff to check out an applicant's credit worthiness themselves. So here's the process. If we start at the top left, in the top left column, you apply to lenders for new credit and loans, you pay your bills on time and avoid bankruptcies and collections, you utilize your credit, access your own FICO scores. What the lender does is grant new credit and loans to you, reports your credit activity and payment history to the credit bureaus. You can access, they get access to your credit reports and FICO scores from the credit bureaus to evaluate your credit risk and provide consumers like you free access to the same FICO scores they use in lending decisions through the FICO Score Open Access program. What the bureaus do is create and update your credit report with public record and lender provided information. It generates scores on the FICO scoring model based on their data from your report, and they make your credit report and FICO scores available to lenders. And what FICO does is create the FICO score algorithms used to generate FICO scores, educates and consults with lenders, regulators, and consumers and other entities regarding the FICO scores. And what that does is enable consumers like you to access your FICO score through the myfico.com, through the open access distributing program. So the big three that we all know, Equifax, Experian, and TransUnion. In the chat, do you believe there are any other bureaus? Yes or no? Just hit yes or no for the chat. For everybody out there, hit the yes or no. Is there any other bureaus? Yes. What do you say, Ray? Are there other bureaus? Ms. Steele, Latanya, are there other bureaus? I'm waiting for somebody to say no. Yes. You just put a question mark at the we'll take that. So here's the truth. There are other bureaus. Yes, there are other bureaus. So check systems, we got Innovis, SageStream, LexisNexis, ID Analytics, MIB, which stands for Medical Information Bureau, Pacer, Factor Trust, NCTUE, PRBC, which is the good bureau, and I'll talk about them in a second. But there are really, truthfully, there are hundreds of bureaus. We just know of the big three because they're advertised so much and people talk about them so much. But there are really hundreds of other bureaus that you all are not aware of. So, as it relates to Equifax, they were founded in Atlanta, Georgia as the once known Retail Credit Company in 1899. Fun fact about them, when Retail Credit Company moved to computerize its records, which would lead to the much wider availability of the personal information it's held, the U.S. Congress held hearings in 1970. This led to the enactment of the Fair Credit Reporting Act in the same year, which gave consumers rights regarding information stored about them to corporate data banks. It is alleged that the hearings prompted the Retail Credit Company to change its name to Equifax in 1975 to improve its image. All right. Next is Experian. This is the leading global information services company providing data and analytical tools to clients around the world. This helps businesses to manage credit risks, prevent fraud, target marketing offers, and automate decision-making. Experian is also publicly traded on the London Stock Exchange. And the fun fact, Experian was formerly known as TRW Credit Services. The former owner of TRW was Bain Capital. The purchase of TRW by Bain Capital was led by Mitt Romney. TransUnion. In 1968, the Union Tank Car Company, which was a rail car leasing operation, created TransUnion as its parent holding company. In 1969, the company acquired the Credit Bureau of Cook County. Most people didn't know there was a credit bureau in Cook County. All right. Fun fact, in 2010, the Chicago-based Illinois Pritzker family sold TransUnion to the Madison Dearborn Group. The company was then sold again in 2012 to Advent International and Goldman Sachs Capital Partners. All right. Innovis, they began as ACB Services, founded by Associated Credit Bureaus, ACB, in 1970. Was purchased and renamed Consumers Credit Associates, First Data Corporation. Their primary function is to sell two important products to credit card lenders. One is the fail-safe. This is a service which compiles data of consumers who have made late payments in the past. Lenders can use this information to screen out good candidates for approved credit offers. And the number two service is New Movers. This is the fun one. Their product tracks customers when they change their address. This allows creditors to send out their credit offers before the competition. So how many of you who have moved to new addresses and you get in the mail a credit card offer you didn't even ask for? That would be one of the services that Innovis provides to be able to get your information to mail you those credit card offers. All right. Check systems. This is the one many banks use. And FACTA is another one that I don't have included here, but FACTA is another one. Check systems is a check verification service, a consumer credit reporting agency owned by the eFund subsidiary of Fidelity National Information Services. It provides information about the use of deposit accounts by consumers. And in 1991, the agency was owned by Deluxe Corporation, and it was part of the spinoff from Deluxe that formed eFunds in 1999. The number of bank and thrift branches served in 1991 was about 59,000. SageStream is a consumer reporting agency that is regulated by the Fair Credit Reporting Act, FCRA. SageStream provides consumer reports and credit scores to different types of companies, including credit card issuers, retailers, and wireless cell phone providers. All right. LexisNexis is a corporation providing computerized assisted legal research as well as business research and risk management services. During the 1970s, LexisNexis pioneered electronic accessibility of legal and journalistic documents. As of 2006, the company has the world's largest electronic database for legal and public records related information. Here's another fact. I want to say in April 2016, 2014, they stopped putting judgments and tax liens on your credit reports, on consumer credit reports, because they found out that a lot of people have false judgments and tax liens on their credit, and those are pretty darn hard to get off. So they stopped putting it on there, and they went and put it on LexisNexis and Pacer, which is the next after this one, which I'll talk about, Pacer, which is similar to LexisNexis. So now all of the judgments and tax liens go on those specific credit reports now. ID Analytics is a leader in credit and fraud risk solutions, which patented analytics, proven expertise, and up-to-minute insight into consumers' behavior. They get paid the big bucks, billions of dollars to learn about you. So established in 2002, one of the nation's largest networks across industry consumer behavioral data. They are rich when it comes to that data. PACER, which stands for Public Access to Court Electronic Records. It allows users to obtain case and docket information from the United States District Courts. Are your court appeals, different courts, United States bankruptcy courts, they hold all that information. It's managed by the Administrative Office of the United States Courts in accordance with the policies of the Judicial Conference, headed by the Chief Justice of the United States. As of 2013, it holds more than 500 million documents and so forth. MIB, Men in Black, I'm just kidding. Medical Information Bureau, MIB, is membership corporation owned by approximately 430 member insurance companies. So in the United States and Canada. They formed in 1902 based in Braintree, Massachusetts. They provide services designed to protect insurance policyholders and applicants from attempts to conceal or omit information material to underwriting life and health insurance. So this is the one that keeps all of your, when you go to the hospital and you tell the doctor all your business and they put it in the system, they report it to MIB. This is where all your medical information goes. When the medical collection is sent out, they send it to them. And then they share that information with the big three. So they all trade information. They're all about making money and trading information. Factor Trust, which is like a sister company to TransUnion. It provides alternative credit data and analytical risk scoring information to help lenders make an informed decision about you. NCTUE, I believe this is the fourth biggest bureau that nobody knows about. This is really hard to find. They are a credit reporting agency whose membership is comprised of companies that provide services such as telecommunications, pay TV, and utilities, and report and share data relevant to their customers' accounts to aid in risk management. So they're the ones with the light bill, the gas bill, account information. They maintains data such as your payment and account history reported by its members. And the last one, I call this the Good Bureau. PRBC means Pay Rent Bill Credit, or Payment Reporting Bills Credit, is a consumer credit reporting agency, more commonly referred to as a credit bureau in the United States. It is similar to the other four U.S. credit bureaus, Experian, TransUnion, Equifax, and Innovis, is that the FCRA compliant National Data Directory. So it differs a little bit differently. Consumers are able to self-enroll and self-report your own debt payment history, and they give you what is called alternative credit. So they can build a positive credit file based on alternative data, such as timely payments for bills, such as rent, utilities, cable, telephone, insurance. Anything you're making bill payments on, you can self-report to them in their platform, and within their platform, they have over 5,800 lenders that has to consider your alternative credit score. So that will be a free source that you can use and self-report and get a mortgage, get a car loan, get a personal loan, get student loans within that platform if you self-report the data within their platform. The service is free of charge. When someone takes out a loan, the lender or merchant would pay a fee to PRBC so they can see his or her alternative credit rating. All right. All right, so how do bureaus make money? Credit bureaus act as what we call information brokers for consumer credit history. They are normally presented as agencies that sell services to banks mortgage lenders, credit card companies, retailers, and other businesses that grant credit. On the surface, the financial arrangement between lenders and credit bureaus doesn't make much sense, but credit grantors provide consumer credit information to bureaus for free, and then they pay to have the credit information sent back to them. So credit bureaus are able to collect, aggregate, synthesize, and analyze enormous quantity of information sent to them. So as it relates to making money, they can make it multiple ways. One is through credit services. So credit services are what most people think of when it comes to credit bureaus. The credit bureaus receives a request from a lender. So if you're going to get a mortgage, they will get the report from the credit bureau, from the lender, and then the bureau sells it to the lender. So the bureau requests it with your permission. They request a report. They pay for it, about 20, 26 bucks, and then they present it to you, right? Another way is through decision analytics. Credit bureaus do not just want to sell a history of borrower payments. Instead, the bureaus package detailed transaction history with analytics about the way an individual interacts with certain debt. Lenders pay more for these types of reports. Marketing, while it's not traditional form of marketing, lenders that offer pre-approved credit are paying a marketing fee to a credit bureau for a list of consumers who meet predetermined requirements. That's what they mean by pre-approved, pre-qualified, if you will, when you receive credit cards, because they took a soft pull and they said, hey, we're going to send you this credit card. You've been pre-approved. You got to pre-qualify. Hey, we've seen enough of what you have. Apply, and we'll send you the credit card. Consumer services, that's when we as consumers go to the credit bureaus directly or third-party credit monitoring sites and pull our own credit report. That's when we can we pay for our own monitoring, our credit monitoring service. Everybody still with me? Still with me? I know it's a lot of information. We're gonna get it. We're gonna get it.
Still here.
All right. All right. So
yeah, I don't really know if my video is working.
So it's going to get better as we keep going. So it's more interesting. So what is credit? Credit is the ability of a customer to obtain goods or services before payment based on the trust that payment will be made in the future. So when someone lends you money, you pay them back with interest, they have extended your credit. How many of us have loaned people money? All of you. If you lying, you flying. All of you have lent money to someone. What is the percentage of you getting paid back 100%? I'm about less than 20% of people that I've loaned money out to have paid me back. So by them not paying me back, they have bad credit with me now. So what is the likelihood of me or you lending out money to someone who hasn't paid you back? 0. Okay, we get it. So credit is the ability to borrow money and manage it responsibly. In short, it means buy now, pay tomorrow. Okay. As it relates to credit, the favorable reputation derived from the confidence of others, honor, good, opinion, founded on the belief of a person's veracity, integrity, abilities, and virtue. Credit is based on trust. A lender trusts that a borrower will honor the debt and pay it back according to their agreement. So a creditor is someone who is willing to place his or her faith in you. The word creditor is derived from the Latin word credere, which means to put faith or trust in, to believe, all right? Lenders, merchants, service providers, known collectively as creditors, grant credit based on their confidence that you can be trusted to pay back what you borrowed, along with any finance charges that may apply. To the extent that creditors consider you worthy of their trust, you are said to be creditworthy or to have good credit. So what are the types of credit? You see I'm breaking it down, going from credit, what is credit, types of credit. So we have revolving credit, which is a secured or unsecured credit card. And I'll share more about those later. With revolving credit, you are given a maximum borrowing limit and you can make charges up to that limit. You must make a minimum payment each month, but otherwise the amount you pay can be any portion of your outstanding charges up to the full amount. If you make a partial payment, you will carry forward the remainder of your balance or revolve the debt. Most credit cards count as revolving credit. Next type of credit is charge cards. Now, this is a little bit special, maybe not as many people's heard, but charge cards may be confused with credit cards. They're not the same. They're similar, but not the same. They operate a little bit different. They differ in the sense that they require a cardholder to pay the entire balance in full each month. You do not leave a balance with these cards, like I said earlier. Once commonly issued by retailers for use exclusively in their establishment, charge cards are relatively rare these days. Unlike credit cards, charge cards don't extend credit to their users. Since charge cards do not allow users to carry a balance, they're not good debt consolidation tools, okay? And I'll talk about consolidation and why it's good, but it's also tremendously bad too. The benefits of it. Next type of credit is installment credit. Installment credit is a loan for a specific sum of money you agree to repay, plus interest and fees. So in a series of equal monthly payments, or what we call installments, over a set period of time, such as student loans, personal loans, car loans, mortgages are all examples of installment credit. Service credit, not heard of at all, but I wanted to include it. Your contracts with service providers such as gas and electric, utilities, cable, internet providers, cell phone companies, and gyms are all credit agreements. So that's the type of service credit. Doesn't show up on your report unless you stop paying, and then they hit you with the collections on your credit report. These companies provide their services to you each month with the understanding that you will pay for them after the fact. So that's what service credit is. You've taken up the service and then you pay later. So why do you need credit? Well, you need credit because a good credit is necessary if you plan to definitely borrow money for major purchases, such as a car or a home, or maybe you want to take advantage of the convenience and purchase protection a credit card can provide. A higher credit score can mean better interest rates, of course, in terms on loans and credit cards. Many credit card issuers also believe or reserve their most enticing rewards for cards for consumers with great credit, right? So lenders aren't the only ones who are concerned themselves with your credit reports and credit scores. Landlords may check your credit when deciding if they want to rent to you an apartment or determining how large a security deposit to require. So I've had clients who made over 150,000, bad credit, and they're trying to move to a better location, but they can't move in those locations because the landlord will not accept a credit score. Even though they have a good payment history of making payments on time for the rent, they cannot move into their desired neighborhood because their credit is bad. Imagine having $150,000, $200,000 to make a salary, and you have to settle for neighborhoods that are less favorable, right? Because the landlords are able to take on those who have what they have. So insurance companies may use your credit scores as factors in determining your rates. Utility companies may check your credit before deciding to let you open an account or borrow equipment. So prospective employers now may use your information found in credit reports to make a hiring decision. So you mean to tell me credit now affects what job you get? Certain jobs, not all, but certain jobs, and they're making it more of a standard over time, right? So it's usually with financial institutional jobs that require require your credit report and see what your personal is like before they hire you. In that regard, your credit report can even be used to verify your identity and for other purposes defined by a federal law. Okay, so what is a credit score? A credit score is simply a numerical expression based on a level analysis of a person's credit files. It represents the credit worthiness of an individual. Credit score is a number lenders use to help them decide, if I give this person a loan or credit card, how likely is it I'm gonna get paid back and on time? So it's generated through statistical models using elements from your credit report, and those elements are your bill paying history, the number and types of accounts you have, late payments, collections, outstanding debt, the age of your accounts is collected from your credit application and your credit report. So what is a credit report? So a credit report is, it contains information about you on a report. Your credit report lists the types of credit you use, the length of time your accounts have been open, and whether you've paid your bills on time. It tells lenders how much credit you've used and whether you're seeking new sources of credit information. It gives lenders a broader view of your credit history than other data sources, such as a bank's own customer data. Credit report also includes information on where you live and whether you've been sued or arrested or have filed for bankruptcy. So what's on the credit report is 4 categories of information. We have first is the personal identifier information, or otherwise known as PI or PII, which includes your name, address, social security number, date of birth, employment information. Your PI is not used to calculate your FICO credit scores. It updates the information come from information you supply to lenders when you apply for new credit, okay? Next is credit accounts. Lenders report on each account you have established with them. They report the type of account, whether it's a credit card or revolving, an auto loan, a mortgage, and so forth. The date you open the account, your credit limit, your loan amount, the account balance, your payment history, including or not have you made your payments on time, right? Credit inquiries is another category that shows up. When you apply for a loan, you authorize a lender to ask for your copy of your credit report. This is how inquiries appear on your credit report. The inquiries section contains a list of everyone who assessed your credit report within the last 2 years. The report you see lists both hard inquiries spurred by your reports for credit, and soft inquiries don't show up at all. These are when you check your credit or when lenders order your report to send you a pre-approved credit offer in the mail. Lenders can only see the hard inquiries on your credit report. Soft inquiries are only visible to you. Soft inquiries have no effect on your FICO scores, but multiple hard inquiries can be an indication of higher risk and may cause your score to dip, depending on if you're rate shopping, and that's a conversation we have offline. And lastly, public records and collections. When you don't meet your obligations to the creditors, you can, there's a way that it includes bankruptcies, judgments, satisfied judgments, liens, satisfied liens, and divorce. Most court records including satisfied liens and or judgments. Collection accounts, when any credit account is referred to as a collection agency or collections department of a credit grantor because of the delinquency, non-payment, or other reason, it shows on a credit report as a collection account. Collection accounts can appear as paid or unpaid accounts. Any account that shows a collection account, whether paid or not, is considered very negative by credit grantors, okay? Credit report sample. So I have a sample credit reports, and I want you all to see what the errors are. So you can unmute yourself for a second. I'm gonna take about less than 3 minutes on this exercise. So here's our first report. Oh man, I gave you the answers, darn it. Here's another one. I done gave y'all the answers. Look, let me go to the next one. All right, so we're looking at a report here, and most consumers would not see anything wrong with this because they don't have, they don't have the trained eye like I do. But I'll walk them through the process to show them what this looks like, right? So if you all can start from the top, right? Start from the account with the issues, the title or the name of the account on the left, and then go to the right, and you will start to see certain things. So what do you see? Is the account numbers all the same?
So there's some numbers at the beginning of Experian.
Exactly. So they're all different. They're all different. That is a problem. Account type, is it all the same?
Yep.
Yes. Account type detail, the next category. Rental agreement. Rental agreement, nope, there's no information here. This is incomplete. This violates one of the Fair Credit Reporting Act laws. It's incomplete. We can't have incomplete data. Bureau code, it's a joint account. Account status. Well, how can it be derogatory and over here it's open? Which one is it? Which one is it? Monthly payment, 0. Okay. Date open. This is very important. So they opened it on, what is 9? Is it September? September? Yep. So September 10th, they opened it in 2016, but here it says September 1st. Which one is it? Is it 2 accounts or 1? Balance. Is it 1,076, or is it 0? Right? So this is impacting this person's credit file. Number of month terms, 27, 0. Do I owe or do I not owe? Right? Credit limit seems to be the same. Past due is the same. Payment status, it's a collection and charge off. Experian says it's a collection and charge off. Equifax is like, I don't know what this is. Which one? Which one is it? Last reported 10/31/2018. Experian says, yeah, it's 10/31/2018. Equifax like, no, it's January 1st, 2020.
Mm.
Which one is it? The comments are all different. Last active date, these two were, so if these are all 2018, mind you, this is April 1st, 2018, how can you last report something in 2020 when the last active date was 2018?
Wow.
Date of last payment, April 4th, April 4th, April 1st. So I made 2 payments,
Mm.
right? Now we go down here to the 2-year payment history. Now, mind you, TransUnion has nothing showing of the payments this client has made. We're going to start January 18th and on down. Okay, okay. Well, here's a 30-day late where my mouse is at, but Equifax is saying it's okay. So was I 30 days late or was I okay? And then okay, 30 days late, 60 days late, 90 days late. It's looking consistent. 120, 150, but this still says 120. And then CO charged off, right? It's charged off, but Equifax is saying it's okay. How can it go from being charged off to okay again? So the account is charged off and I'm making payments again? That don't add up. So this is why I go to bat for clients. What they don't see is what I see. I just gave you a demonstration of what I see. And here are all the errors. Here are all the errors. There's more to it because this is just one showing one account. So that's an example of, you know, me going through an account with clients. So hope that was a good exercise. So moving on. Yes, I got 69 minutes left. Yes, okay. So let me go to the next. Did it freeze? All right, okay. So let me go back. PowerPoint just went out. Hold on, I'll bring it back. I was doing too much. They said, "Nah, bro, we can't have you showing out in the presentation." So let me get it back. Oh, file, open recent. All right, so here it is. Let me go to the place where we stopped. I'm glad I know technology. I would be moving this fast. All right, and
You still have shared screen?
yeah, I'm about to.
Okay,
And
good.
There we go. Yeah. So previous slide. Now we back to. So if anybody wants to pull their own report, they can go here. It's only $1 for the first 7 days. If you want to set up a consultation, we can, you know, I'll give the detailed link and instructions at the end. So how to build credit. This is the one everybody looking forward to. So here are the ways to build credit. Apply for a secure credit card. Apply for a credit builder loan. So if nobody knows, secure credit card is when you put up a deposit into a credit card account. That becomes the limit. And whatever that limit is, you don't go over 30% of that. In exchange for putting up a deposit, a secure deposit, the bank or credit union will report to the credit bureaus on your behalf for having that account. So it shows up as a revolving account on your credit report. A credit builder loan is a forced savings account that you can establish with your credit union or bank. I do have a few resources for secure credit cards and credit builder loans if you want. After the presentation, you definitely ask and I'll direct you to some of those that are very good. Credit builder loan is a forced savings account the way you establish with your credit bank or, your bank or credit union. And you say, hey, I want to deposit $50 a month for 12 months. That's $600 a year. That money is going to go into the savings account. It's going to build interest. And what the bank is going to do is take out a loan and report that on your credit file as an installment loan, and it's going to have the balance of what you need to pay, which is $50 a month. So while you're depositing, they're reporting to the bureaus on your behalf, because it does cost to report to the bureaus, mind you. So in doing business with them, they're going to report on your behalf and help build your credit that way. A secure credit card and a credit builder loan are great for those that are trying to start their credit or recovering from a financial hardship. Credit card, for the rent you pay, you can use PRBC, or there are third-party companies that talks to your landlord to get the rent payment for the last 24 months, and they self-report it to either TransUnion or all three, and there's a company for that. And if you want that information, I can give it to you later. Personal loans, of course, credit cards, retail store credit cards, removing negative information from accounts and updating. Asking for a credit limit increase. So let's say somebody has a $1,000 credit card, they have a 50% utilization, so they use 50% of the balance, which is 500, and you ask for a credit limit increase to additional 500. Well, you just lowered the utilization, which increased your credit score because you're over the threshold, you're over the 30% limit. Borrowers from lenders that report to the credit bureaus, of course. Diversify your credit, meaning apply for different types of accounts. Piggybacking, I'll talk more about this. That includes cosigner, guarantor, joint account, and authorized user, which is my favorite. All right, so credit score breakdown. So if your credit score ranges from 300 to 850, how many points are in between? So if by default you get 300 points automatically, how many of the rest of the points that you have to work for? You guessed it, you're right, 550. So here's how to get the perfect credit score based on the FICO scoring model. The first category is payment history. Payment history accounts for 35% of your score. 35% of 550 equals 192.5 points. The solution to getting all of those points in that category is to make 100% of your payments on time. Utilization accounts for 30% of your score. 30% of 550 is 165 points. The solution to getting all of those points in that category is to pay your credit card balance in full each month. Now, I always get the question, well, Mr. Jackson, I always pay my bills on time, but it doesn't seem to be going up. Here's one important detail. You may want to write this down because it's not in the slides. For those of you that have revolving credit cards, there are two dates that you need to be mindful of when you have those credit cards. The one we all know is the due date. The second date is the statement date, right? The due date is where we make the payment in full. The statement date is where they take a snapshot of where you are and report it to the credit bureaus. So for example, let's say I have the $1,000 limit credit card. I use 75% of it, so that's $750. Of the balance that's left on my card. The statement date could be on the 21st and the due date is on the 30th. Today is the 19th. I spent 75% utilization of my credit card. Soon as the 21st hit, they take a snapshot, send that information to the bureaus. The bureaus reported the information on the report. It lowers my credit score because I'm over the 30% threshold. Even though I pay my bill in full on the 30th, I have to wait till the next month on the 21st where my utilization is lower, and then they take a snapshot of that and send it out. Hope I didn't lose anybody with that. I know that's a pretty advanced way of explaining it. So length or age of credit history is 15% of the score. 15% of 550 is 82.5 points. The solution to getting all of those points in that category is to have 15 or more years average of all accounts. Example, let's say everyone has nothing on their credit report. They're a new college kid, fresh out of college, coming out, and then you apply for your first credit card. You're 20 at this point. 15 years later, you're 35, you've had that credit card for 15 years, you took care of it, great job. And then the next day you see this nice black card, this American Express Centurion black card that you want to apply for. You have 15 years of history on this one credit card. You open this new credit card that creates 0 years, one new inquiry. The type of account is revolving. You haven't made any payments yet, and you haven't utilized the credit card yet because you just got it. So to find out the average, you take the 15 years plus the 0 years, you add it together, it's 15. You divide it by how many accounts? It's 2 accounts. 15 divided by 2, 7.5. So what does that do to your 82.5 average score? It divides it by 2 because you open up a new account and it took the averages of years of the accounts and you reduced it by half. So if you all are going to open credit cards, make sure they're within 2 years of each other. And make sure it's credit cards that you know you're going to use and need. If you have credit cards that you don't really use anymore, be careful with that because creditors can close the accounts if you don't spend anything for 18 months or less. They will close those accounts. All right. So what you want to do is if you have a subscription service that you're subscribed to, have that subscription service be on that credit card. Pay that subscription service with that credit card. Select to auto pay on the statement date, right? Make sure it's less than 30%. Have it auto pay and don't worry about it. And it'll take out from your bank account to pay for it while you're reaping the rewards from the card. So that's one way to use it if you don't use your credit cards. The next category is types or mixed use of credit. That's 10% of your score, 10% of 550 is 55 points. The solution is to have a combination of installment, revolving, and charge cards, or what we call open-ended accounts. They're also known as charge cards. So have 3 or more installment, 2 or more revolving, 1 or more open-ended or charge cards, all right? Next is new credit increase, 10% of your score, 10% of 550 is 55 points. The solution is have 0 increase to get all the full points for that. But I know you're probably like, well, we need increase. Yes, you do need increase. However, with increase, mind you, they are, once you get a hard inquiry, you get the points back after the first year and they come off after 2 years statute of limitations, okay? So what is a secure credit card? I think we talked about this. I won't go into much of this. We talked about secure credit card. We talked about unsecured credit card, which is you don't have to put up a deposit to get something. I want to skip this because we kind of know what it is. And if you don't know, just bleep me in the chat if you feel that you don't know. But I want to skip this portion of it mainly because we don't really technically need that portion of the information. Let me move on. So free up more time. Wait. Where's the presentation? Okay. So charge card, I explain what that is. You don't leave a balance. I explain build a loan. Okay, how's interest calculated on the credit cards that you have? So how's it calculated? This is really good. I think that you all will love this portion of it. The interest you pay depends on your APR, which stands for annual percentage rate, and your balance avoid interest entirely by having your bill in full. So if your credit card has an annual percentage rate of, say, 21%, that doesn't mean you get charged 21% interest once a year. I'm explaining what happens. So depending on how you manage your account, your effective interest rate could be higher or it could be lower depending on the credit card you get. It can even be 0%. That's because interest is calculated on a daily basis, not annually, and it's charged only if you carry debt from month to month. That's why they say always pay your credit cards balance. Now, here's a scenario, and this is a real, people deal with this every day. This is a real life scenario. Let's say you have an unsecured credit card with a $5,000 limit. You max out the credit card, and now you owe $5,000. Your interest rate is 21%. Your monthly minimum payment is $100. And let's assume you make no more transactions and only pay the minimum balance on the card. All right. So I want to look at you guys' faces when I see this one. Let me look at, put y'all videos on. I want to look at you guys' faces when I do this, because this is going to be dope. Put y'all video on that. I got to see y'all face. So, all right. So now you owe $5,000. Your monthly minimum payment is $100 a month. Your interest rate is 21%. To find out what your monthly rate is, you take 21%, you divide it by 12 months. The answer is they charge you for leaving a balance on 1.75% per month, or 0.0175, okay? Your interest payment, 0.0175 times 5,000 is $87.50 is your monthly interest that's going straight to interest, not principal. To find out the principal, you just take the $100 minus the $87.50, and it's $12.50 monthly principal. It gets way better. It gets so much better. Like, so now that you know that for every time you spend $100, $87.50 is going to interest, and $12.50 is going to principal. Now, the reality is 5,000 divided by 1250, it'll take you 400 months to pay that off on a $5,000 balance. It get Tanya, these facial reactions is priceless. I gotta have it. Your sentencing, 400 months divided by 12 months, it'll take you 33 years to pay off. I know. It's petty. I know. Now, here's the best part. Guess what the banks made? The bank, 100 times 400 months, they made $40,000 on the $5,000 limit. Yeah, absorb that. Absorb that. So when people say, oh, I leave a balance on my stuff all the time, you're giving up so much money. Now, mind you, this scenario is if someone doesn't make any more purchases and just pays the monthly balance. Now, we know today that ain't true. People still using up the balance, and they're still paying fees and interest. So they can have it for more than 33 years. I can put anybody's number. If you got credit cards, I can put your same numbers in here, and I can tell you how long you'll be paying. So here's a formula. So this is without extra fees, or you run up the balance again. And these are the formulas and what you're seeing. This is how I've devised it up. It's recorded, so you'll be able to come to it at any time. All right. So piggybacking, cosigner, guarantor, joint account, authorized user. Here's the pros and cons of each one. All right. So with cosigner, guarantor, this is a very common strategy for someone who needs help building credit fast, is to apply for a credit with a cosigner or guarantor, which is the person who can be responsible for the debt in the event that the primary borrower cannot pay. The cosigner or guarantor does not typically receive access to funds or make payments on the debt unless the primary borrower is no longer able to. So the pros of a cosigner is that the cosigner or guarantor's credit record or income are considered when applying for credit. The primary borrower may be able to piggyback off the cosigner's good credit to qualify for credit or get better terms. The cons are getting credit with a cosigner or guarantor means opening a new account, which deems credit temporarily or gives you an inquiry. It's still going to take a few years for the account to age enough to help build your credit score. A mature account is 2 years or more, okay? It may be difficult to find someone willing to co-sign on a loan or a credit card since it is a risky proposition without much benefit for the co-signer. Some lenders, particularly credit card issuers, may not even allow co-signers. It's one of the cons. And it may be difficult or impossible to remove a co-signer in the future if the co-signer must be willing to potentially be permanently associated with the account. Joint accounts. With the co-signer and guarantor, they might as well just be joint accounts because that's what it kind of operates the same way. Joint account holders, two parties apply for one account they can both use. Both parties have full access to the account and both are held responsible for the account. Joint accounts are mostly common used by spouses with shared finances. Some of the pros is that with applicants are considered by the lender when issuing credit by pairing with someone with good credit. A person with less than perfect credit may be able to open an account that they wouldn't have been able to qualify for on their own or get more favorable terms. If the joint account is kept in good standing over time, it can continue to build credit in the user who needs to improve the credit profile. A joint account can make it easier for two people who manage their finances together. Both account holders have access to the privileges associated with said account and the rewards. A joint account is also considered a primary account since each borrower has full access to the account and full liability for the debt. The cons are opening a joint account means adding a new account. Both users are fully responsible for the debt. If one person maxes out the account, you know, stories I've heard is married couples who are divorcing and they max out the account, you both still responsible. You just can't pay your half and they pay, you know, not pay their half. So the other can be legally held responsible. It's always possible that an event such as a breakup could change the relationship between account holders, which could make it difficult to manage the account. Cons, some more cons, disagreements over the account could damage the relationship between account holders. It might be difficult to find someone to open a joint account with you if you do not have a spouse or if your spouse does not want to combine finances. Not all lenders provide joint credit accounts. Many joint accounts do not provide the option of removing a joint account holder, so both users are often attached to the account permanently unless they decide to close it altogether. Sometimes you can't close it without the permission of the other account holder. That's also another con too as well. Authorized user, I love this one. This is the best one. Authorized user, it's a classic example as parents who add their children if they're less than, you can add children less than 18 as an authorized user on your credit for the purpose of helping them build their credit history. The young adult, often young adult does not even get a credit card, so they can't make changes to the account. The goal is solely to have the account show up on their credit report. The pros is you can show up on the authorized user's credit report as soon as the next reporting date for that credit card, which means you can build your credit fast. Only the primary account holder is responsible for the debt incurred, not the authorized user. Only the primary cardholder's credit file is considered when the credit card company issues the card. Therefore, many times an authorized user may be added to the account even if their credit is not as pristine as the primary cardholder. The authorized user's credit score does not affect the credit of the primary cardholder at all, as long as the authorized user does not increase the utilization of the account by making charges. Now, that's only if, as a parent, I make let's say I had a son, I make him authorized use my card, and I give him his own credit card attached to my file, and he can, you know, skyrocket the utilization and stuff like that. But usually, you don't have to do that if you don't want to, as it relates to that. The pros, being an authorized user can be a great way to build credit fast for those that are trying to apply for a mortgage or get their own credit card or loan. The authorized users can remove themselves from the account if they no longer want the account to appear in the credit report. The cons are authorized users don't have the ability to make changes to the account like the primary account holder does. The primary card holder does not even have to give the authorized user a credit card. I don't see that more of as a con. I think it's more of a you don't have access to it unless the primary cardholder tells you. If the account shows up any negative behavior such as late payment or high utilization, this will be reflected on the authorized user's credit report, which may be counterproductive to the goal of building credit. So you can't control what they do with their card. What are CPNs? I get a lot of questions about this, and I know y'all probably raving in the background. Let me see your faces. Let me see your faces. Okay, so CPNs, CPN or CPN number can stand for credit privacy number, credit profile number, or consumer protection number. A CPN is a 9-digit number that is often marketed as a replacement for your Social Security number. Some sources claim that celebrities and government officials use CPNs to maintain their privacy since social security numbers are linked to a lot of personal information, but there's no documented legitimate source for a CPN. The Social Security Administration is the source for all social security numbers, and the Internal Revenue Service, IRS, is the source for all employer identification numbers, EINs. These organizations do not issue CPNs, and no other government entities issue such number. So where do they get these numbers? All right. So you may have seen some businesses claim to sell CPNs as a way for consumers with poor credit to apply for credit with a clean slate. Since the CPN is a different number than your Social Security number, it does not have your credit report associated with it. These companies would like you to believe that you can purchase a CPN and use it instead of your Social Security number on credit applications, thereby hiding your credit history from creditors. Since the federal government does not require that consumers provide Social Security numbers on credit applications from private companies, you are free to withhold your Social Security number. However, the creditor who you're applying for or applying to is also free to deny you your credit without this information. So they're able to deny you of the service. They're able to deny you of getting that credit card or that loan. So the reason some people can get away with using false Social Security numbers sold as CPNs on credit applications instead of the real Social Security number is that lenders sometimes fail to cross-verify applications thoroughly enough to confirm that the name of the application matches the listed Social Security number, okay? So in reality, there are two ways that disreputable companies obtain so-called CPNs, both of which are illegal. They use real Social Security numbers that have been stolen from other people, often from children, elderly, deceased people, homeless people, or those who are incarcerated, all right? So scammers target these demographics because they are least likely to notice that their Social Security numbers have been compromised. If someone promises to sell you a CPN that has a certain credit score or credit report, this is a big red flag that it's actually a Social Security number that has been stolen from someone else, all right? So they create new fake Social Security numbers that have not been issued by the United States government. They do this by using algorithms to generate 9-digit numbers and checking them against online databases to see which numbers can successfully pose as Social Security numbers. They then sell these numbers as CPNs to unsuspecting consumers, all right? So the truth is there's no legitimate way to obtain a CPN because CPNs are not issued or recognized by any government agency. As described above, the only way to get a CPN is to purchase a stolen or fake Social Security numbers on the black market or the dark web. So as it relates to the Goodwill letter, I guess I can talk about it a little bit. So the Goodwill letter is a way for people who have a missed payment or late payment, like a 30-day, 60-day, mostly 30. This will really apply to a 30-day. So a Goodwill letter is a simple way to repair your credit report. It can be used for both federal and private loans. So the purpose of a Goodwill letter is to restore your credit to good standing by having a lender or servicer erase a lateness on your credit report. Typically, those that have experienced financial hardship due to unsuspected circumstances or forgot have the most success with Goodwill letters, but you have to communicate with the creditors. You have to communicate this. All right. It can also be used when you think about late payment. If the late payment is an error, they allow you to take responsibility for your actions and ask. You want to ask in a very nice way. If your student loan servicer can empathize with the situation that caused the lateness or whatever situation you have. For example, if you are in deferment or forbearance during the time of the late payment and you weren't required to make any payments during this time, or if you know you've never been late on a payment before. People with really good payment history can use the Goodwill letter most often because they have a track record of paying on time. What makes a convincing Goodwill letter? So if you've been looking for a goodwill letter that actually works, here are some tips of what you should include in your letter. An appreciative tone. It's important to that the entire tone of your letter read as thankful and conscientious. So if you were actually late on your payments due to an extenuating circumstance, you should take an angry tone in your letter. You shouldn't take an angry tone in your letter since you were in the wrong. Another tone is to take responsibility. You want to be convincing and honest, take responsibility for the late payment, and explain why it happened. They need to be able to sympathize with you. Saying you just forgot isn't going to win you any points sometimes, right? A good recent payment history. All this explains is that you have a really good history of making payments on time. If you have proof of any errors and relevant documents that you can show for. Where to send a goodwill letter. So now that your letter is written, you have to send it. This can be done either by fax or by mail, or you can send it online via mail. Most credit services have their contact information on their website, but you can also look on your billing statements to see if they specify a different address. Additionally, you can try calling the credit bureau the lateness was reported to and see if they can give you the contact information you need to find that creditor. It's definitely important to mention that the goodwillers are not a means to immediate success. So it's often takes several attempts to correspond with servicers and lenders to get them to acknowledge that they received a letter from you, okay? We're going to go to how to, I don't want to spend too much time. This is a lot. I know it's a lot. Let me go to this one. I had this planned. It'll take me like 4 hours, so I'm just condensing the information. We're going to have to set a whole new marathon of topics, but I'm only want to give you the ones that's most important at this point in time. So a dispute versus a challenge, the difference is a dispute, what mostly 90% of people, 95% of people do, is an argument of the fact of truth, the fact of correctness, or the facts of completeness. It argues against the truth and validity of the item that's already being reported. Whereas a challenge, we ask for certification of truth, correctness, completeness of such item. What I'm concerned with is the process of how the item or the account is reported versus validating if it's your account or not. When most people dispute, they use templated letters that say, hey, the account is not mine, with me in the back of my head. I know it's yours, but you're just saying not mine so they can, start an investigation. But what I do is challenge how it's reported. So in the example previously, I showed you some of the errors there, how they were reporting it, and it can't be right and exact if it's reported wrong. So that's grounds for deletion based on how it's reported versus me proving if it's your account or not, so that you know the difference. So what is the statute of limitations? Statute of limitations is a rule that sets a time limit within which the creditor may sue you for payment of a debt. The length of time that a creditor has to sue you on an unpaid debt varies from state to state. In some states, it's 4 years. In other states, it might be longer. It just depends on whether you have an agreement with the creditor in writing or not, or whether the debt is a special type, like a revolving or open-ended account. So a collection account lasts for 7 years. It's really 7.5 years, but to the public, it's 7 years. That still remains true. But let me tell you the process of why it's 7.5. It's 7.5 years from the date of the initial missed payment that led to the collection, or what we know as the original delinquency date. So here's how it works. Before COVID-19, you was making your bills and paying everything on time. Now, COVID is here. You don't have much saved up. You gotta keep all the resources and money that you can so that you can survive and pay some bills, really essential bills. So that credit card payment, you can't make the payment. It starts what is called 30 days late. That's the delinquency. That's the original delinquency. That's where it starts. So 30 days late is where it starts. 30 days late, 60 days late, 90 days late, 120, 150, 180. 180 days is that 0.5. Now, me as a creditor looking at you, you're not paying me every month. So I'm going to say, okay, it seems like I'm not going to get this payment from this client, from this consumer. Why don't I sell that information to a collection company, see if they can recover the money from me or just sell it to them outright. So now, after 180 days or sooner, they can literally send it. They can send your account to collections on the first delinquency, on the 30-day late. They don't have to wait 180 days, mind you. So after 180 days, that 0.5, now they send it to the collection companies. The statute of limitations now begins 7 years, right? So that's where it goes. Charge-off is the same thing. The difference between the charge-off and the collection is, with a charge-off, this is the company. I'm the creditor, you're the consumer. You don't pay me my $5,000 loan that you owe me. So I say, okay, I'm gonna charge it off as bad debt. So I'm gonna fill out what is called, don't quote me on this, but it's a 1099 debt form, a debt forgiveness for a form or some sort, 1099-C, I have to remember. But it's a 1099 form that I fill out. I charge $5,000 as bad debt, send it to the IRS. What they can do in return, if it's $600 or more, they can send you a 1099 for $5,000, and now you have to pay taxes on that $5,000 that you thought you was gonna get out of paying. So now it's added to your income, along with the $5,000 is added to your income now. So that's one way they can do it. And the collection is when the company, me, when I sell it to a collection company, or I'm hiring them to receive payment from you in that form. Bankruptcy, chapters 7, 11, and 12 will remain on one's credit report for 10 years from the filing date. Chapter 13 is reported for 7 years from the filing date. Accounts included in the bankruptcy will remain for 7 years from the date reported as included in the bankruptcy. Judgment remains 7 years from the date filed. City, county, state, and federal tax liens, unpaid tax liens remain for 15 years, and paid tax liens remains on your report for 10 years from the date of payment. Inquiries, most inquiries listed on one's credit report, I say will remain for 2 years and stops taking effect after 1 year. Okay, so here's the chapters explain. I get this answered a lot. What are the differences? So chapter 7 bankruptcies essentially allows the debtor to make a fresh start, so a clean slate that lasts for 10 years. Chapter 13 is designed for an individual who has a regular source of income and they have a desire to pay his or her debt. So you make up a payment plan, but is currently unable to do so. That is 7 years. Chapter 11 bankruptcy is for businesses. This primarily applies to commercial enterprises that wish to continue business operations while repaying creditors through a court-approved reorganization plan. So it's like the business bankruptcy. Chapter 12 is provided debt relief to family farmers with regular income. Chapter 9 is for municipalities such as cities, towns, villages, counties, taxing districts, municipal utilities, and school districts that may file for Chapter 9 bankruptcies. Tax liens mean the failure to pay income tax or tax on real personal property. Evictions is when, of course, the landlord removes you from a rental property, most commonly due to non-payment. Judgments on any credit report means the involvement of the person in the lawsuit, their obligation to pay a certain amount to the other party. So if you have a 30 days late from a consumer standpoint, usually on credit cards and in some installment accounts, 30 days late affects your score for 9 months, meaning they hold your points. 60 days late affects it for 3 years. 90 days late affects it for 7 years. 90 to 180 days, really, it's still 7 years, right? Right, but for those with mortgages, who has a mortgage? Anybody got a mortgage? Y'all have mortgages? All right, so mortgage is a little bit more strenuous. So if you have a mortgage account and you're late 30 days, it takes 2 years to rebound. If you have a 60-day late, it takes 5 years, and you have a 90-day late or more, it takes 7 years to rebound. Here's a chart on what affects what. So damage points, how mistakes affect credit scores. It's based on FICO. So here to the left is the credit mistake. In the middle is if your score is 680, if your score is 780. So if you max out your credit card, you're looking at 10 to 30 or 25 to 45 points. If you got a 30-day late, that's 60 to 80 points or 90 to 110 points roughly. Debt settlement, 45 to 65 or down, or with a 780 and above, it could be 105 to 125 points below. Foreclosure, 85 to 105 and 140 to 160. Bankruptcy, 130 to 150 and the 220 to 240. Look at that. Oh, man. Two more. It's like, no. No. So if people are wondering what happens when you get hit with, well, this is what happens. This is what you see typically. All right. Y'all learning something? It's good. We're good so far. The information's great. Okay, good, good. All right. So what do I have next? Okay, let me go down. I think that's what I have. Okay, this goes into business credit. Okay, that's business credit. That's a whole nother workshop tomorrow. So that was, let me go to this one. Right. Did I delete it? So that is the presentation so far. So I need an hour and 30 minutes, about right. I didn't want to make it too long. That would have took like 3 to 4 hours. But definitely want to thank you for viewing the presentation. It was a little abrupt. And the slides didn't have the order that I like because it crashed. The original PowerPoint had everything in order. And then when it crashed, it put me back to where I previously pretty much ran it, where I previously edited the slides. So it was all over the place. So my apologies for that. I didn't think this would crash in the middle of a presentation, but here's my survey. Please take it, bit.ly/CH survey rating. If you want to set up a free 30-minute consultation about your credit, there's a link there. Is everybody on? Let me see. This is where we have the question and answer piece. Oh, let me explain consolidation so that people out there can understand this, especially for those that's going to be watching in the future. With consolidation, it can be both good and bad. The good part about it is that it can take all the accounts and put them into one, and you may be paying a low monthly fee, right? It depends on what your credit score is at the time and what the rate is. The con to a consolidation is that, let's say for student loans, because this is an example I use all the time. You have a student loan and you've had it for about 10, 20 years. And then once you consolidate all of those accounts, what you do is close all of the history, all the student loans, and you make one new one. So 20 years of history down to zero is what that creates, plus a new inquiry. And you're hoping that this newer, lower monthly rate, the previous one was going to have you in debt for maybe 25, 30 years. This new one, about 45, 50, 60 years, you'll be paying on that student loan. Right? So it all depends on the numbers. So if your credit is really tight, really good, you may get a lower rate and it may be much less that you pay. It depends, right? But a consolidation is not always good. Some situations where it's really good, some is not. It just depends on everybody's situation, right? So that's the presentation. I want to know if you guys have questions, and I'd love to answer them.
So I have one question. When you were talking about the joint accounts and that kind of thing, so if you're not paying on time and it's two persons on the account, does it affect each person's rating separately?
You won't get the same because you're a joint account. You both are responsible for it. So whatever happens on the account, both are reflected. Yes, both are reflected. So if it's bad, you both get bad.
So it'll be bad on my personal credit and then bad on somebody and the other person's personal.
Yeah.
So we'll have the bad rating on both sides.
Yes, you will.
Okay.
For that specific account.
Okay. Okay. Yep.
Great question.
Mm-hmm.
You got something, Tanya?
Yes. So so how long does normally the whole process take to repay your credit? Does it depend on how low your score is, or if there's inconsistencies as you talked about before?
Right.
What is the best way to go about that if you have to repair your credit?
Right. So it all depends on your information on your report. So everybody's situation is different. Right. And in order to, I gave you the ways to build the credit. To repair it, you remove negative account information, you get stuff updated. But I won't know until I see a report. But what most people do is focus on the score. The score is not the most important thing. What's most important is the data that's reported on the score, on the credit report.
Okay.
The data is what makes up the credit report. So if you're paying your bills on time, you're keeping your utilizations lower than 30%, you're keeping your accounts open as long as possible, you have different types of accounts that you've applied for, you have less than 10 inquiries, right? It will reflect positively if you're maintaining those accounts. But if you're having late payments, you got a bankruptcy over here, you got a collection over here, it's gonna hold those points for those amount of time. That's why I went over the statute of limitations as it relates to collections. It hurts your score for 7 years. And you're responsible for that debt for the 7 years, statute of limitations. But they can still come after you. Even if it's not reported, you still owe the debt. It's just not reported, right?
Okay.
So it all varies based on your credit file. I'll know more when you pull a credit report. I can walk you through exactly what needs to happen. I'm sure you do. Yeah.
Thank you.
You're welcome. Anytime. Anybody got any other questions? Tanya, Ms. Gunyard, you looking kind of focused over there. You kind of focused. No. Any other questions?
I'm focused though.
You got a question, Ray? Unmute yourself if you got a question.
Can you hear me?
Yes, sir.
Yes.
Okay, so I was wondering, I was kind of following up on the last lady's question. With respect to this kind of cat and mouse game with the statute of limitations, I had heard that the creditor can extend the statute by refiling, and that sometimes to put an end to it, it's a matter of negotiating with the creditor, so that they'll just stop, refiling. And
right. So to re-up or re-age the file or account is illegal. The only way they do that is when you make a payment. What that does is restarts the date of last activity. That's where the new 7 years come from, as it's reporting on your credit file. Great question, Ray. That was a good
so sometimes people just do that illegally.
If you do it, that's illegal. And now, if you find that out, I have a consumer attorney that would love to work your case. They'll work it for free because that's an easy freebie. And you can get up to $1,000 for that violation or per violation. Plus, not only do they do it free, but they'll also work to get that deleted too.
Thank you.
Yep. Great question. Great question. Rhea, TB, I don't know who TB is, but TB. Anybody got any other questions?
No, this was a great presentation. You know, I've seen some of it before, but that whole credit thing, how long you paying on a credit card, wow.
Man, look, people only knew. Like, that's just one scenario.
Yeah. So at one time I worked for a finance company, And the game was to, just give the customer a little more money. And even though they're way behind, at some point in time, the credit insurance is going to pay off the whole thing.
Wow, it's a whole nother game.
Yeah, it's all, it's bad gamesmanship though. I mean, it's taking advantage of someone who doesn't know that they're getting scammed in a sense by taking on more credit that's going to stay on them forever.
Mm. I've heard of guys starting their own collection companies. They'll have a credit repair company and then start a collection company, and then go to collection company, buy the debt, and then sell it back to their own consumers to make it seem like, hey, give me this one-time installment fee, which they pay pennies on a dollar to the creditor, to the collection company for. They got the debt now, and they get a settlement and get it removed. I said, whoa. I said, you guys are, that's a whole nother level. I don't think it's illegal, but it's just frowned upon, in that regard. But they found a loophole. I can't do nothing at them. So.
Yeah.
Yeah. Any other questions? This is the time for questions. I went fast enough so I can answer questions.
So you're going to be able to send us your deck?
What is that?
It's going to be recorded.
Oh,
It's recorded. She's going to send a recording. I cannot give out my PowerPoint. I have over 30 presentations.
Yeah, so this is recorded. So as soon as it hits the cloud, then whoever signed up for the registration, I can send it to you.
Awesome.
Yeah. So here's my information. Definitely take the survey if you have time. Please give me feedback, honest feedback. What topics you like to see included, what other services you want to see, and things of that nature. That's how I get better at these presentations, by having the feedback from you guys.
Yep.
So if you want to set up a 30-minute consultation, I'll work with you to send out your first set of letters at no cost. That's granted if you mail them yourself. So I'll make the letters and you mail them out. If you want to do business with me the following month, it'll just be a ongoing basis fee of $37. But that you come back to me for the additional letters whenever you want. There's no monthly recurring fee for that. You just, whenever you want letters, I'll make it for you and give them to you to mail, and I'll put you in my portal and you'll have all the resources. If you subscribe, you'll get emails from me on different strategies and ways to leverage your credit that are not being talked about in the public. So I'm always re-up and updating information and getting a new law information to send to people that subscribe to as well.
Great. That's everything went very well. Thank you so much for just sharing a wealth of information. Now you'll be back with us on Friday, right?
Yes.
For part 2. So definitely you want to tune in so he can give us more wealth of information and details. So we're really excited. And hopefully the information the knowledge that was given, the history was great, because a lot of people don't know the history of where credit came from. So that in itself is a bonus. And so we're just really glad that you were able to share that information, and, tell your friends, tell everybody to tune in with us on Friday so that we can go even deeper. But again, thank you very much. I appreciate you.
The personal credit again, this one again for Friday, right? Okay.
Yeah, you just said part 2, so what's the...
You got access to next one. Okay. Yeah.
Okay. And Rhea said great presentation. So again, make sure you guys fill out the survey and get that done. Also, go check out our website at www.gecdc.org and hit the events tab, and you'll be able to see all of the events that were coming up. So make sure you register for those. We got a lot of stuff coming out, and appreciate you joining us on today. And if there are no more questions, we will end this webinar. Let's see, somebody missed. I'm sorry. What are you saying, Rhea? I get.
Let me turn on my map. Some people missed it. For whatever reason, they weren't able to sign on correctly. So I was wondering if you'd be willing to do a repeat session.
That would be the Friday, won't it?
Yeah, Friday. So he's gonna do this again.
Okay.
Will there be any new information that you're gonna share with us that you didn't share today?
I mean, for the different topics, hold on, let me show you. So,
Hey, Rhea,
Yes.
this is Ray. I noticed I couldn't get on when I first signed in.
Okay.
So what I did was I left it open and I went to another source, like using my iPhone, and did it that way and got right in.
Okay. Yeah. Somebody just emailed me and said they weren't able to. They registered, but they weren't able to get through.
tomorrow, would you want me to talk about business credit for the next session instead?
Yeah, that would be great. And just understanding the difference between personal credit and business credit, because a lot of the businesses don't recognize how they can build up their business credit so that then when they get ready to buy stuff for their business,
No problem.
you can use your business credit. So that would be great.
I have that. I got
Okay.
that. Yeah, I got that ready. So I'll talk about that.
Okay, so, on Friday, we're going to then just do a little bit of recap. We'll jump right into business credit. I think people really need to understand how to build up their business credit so that then when they purchase and everything, and how business credit works compared to personal credit. I think that would be important. So, yep. Okay, so great. Again, thanks everybody for joining in with us. We really appreciate it. And just keep in contact with us on our website at www.gcdc.org, and click on the events tab and you'll see all of the workshops and things that we'll be doing. And you can always reach out to us if you have questions. So I'll see you guys on Friday. Bye-bye. Thanks for joining us.
All right.
Bye.